Well, good afternoon. Excited to be here on a fairly good temperatured Wednesday in Sacramento. It's been pretty ugly here with triple-digit temps in the past weekend, but we've got a little bit of a respite for that, from that, and obviously for that, we're excited. So we're going to jump right into things with regards to the webinar. Obviously, Bitcoin and to a lesser extent, Ethereum are two of the most popular of the 4,000 different cryptocurrencies that are in existence as of January of 2021. Crypto has exploded in popularity, needless to say, over the past year, and has emerged not only as a new asset class, but also as an alternative store of value. Also, some call it digital gold. The United States government, needless to say, has dramatically increased the money supply since the beginning of the COVID-19 pandemic last March. And this has led to a decrease in the value of the US dollar and concurrently has stoked some fears about inflation. So as founder and president of Towerpoint Wealth, my name is Joseph Eschleman, and it is my pleasure to welcome all of you to today's webinar, What is Cryptocurrency and Why Would You Want to Own It? Before introducing our featured guest, I would like to take just a quick moment to address three housekeeping items. Number one is social media. We will be posting a replay of this webinar on the Towerpoint Wealth's social media channels. And I would like to take just a moment to encourage all of you to get out your phone. Please, when you do, open up your Facebook app. And in the search box of Facebook, please type in Towerpoint Wealth. Once you see us and our company and logo, in the interest of following us, just simply click on the thumbs up button. And we should have a replay of this webinar probably in the next couple of days. And we obviously are interested in building our social media presence and have gotten a lot of good feedback as far as the cadence and the types of issues that we're covering and posting about. Number two, question and answer. In the interest of just respecting people's time today, we will not be directly addressing questions during the presentation, just in order to keep it to 25 or 30 minutes. But we will be happily taking questions throughout the presentation. Each and every one we'll be happy to address after the formal presentation is over. And number three, I don't want to say most importantly, but we're happy to make sure people are aware of the fact that we at Towerpoint Wealth are proud to donate $10 for each of you in attendance today to the Leukemia and Lymphoma Society. So give yourself a little bit of a pat on the back for helping, obviously, an incredibly important charity. Now, joining me today is Christopher King, who is the founder and CEO of Eaglebrook Advisors. And together, Chris and I look forward to discussing the risks and rewards of crypto and how cryptocurrencies and digital currencies can play an important complementary role within a properly diversified investment portfolio. Based in Washington, D.C., Eaglebrook, Chris's company, is a crypto-focused investment firm that serves independent firms like Towerpoint Wealth. Eaglebrook is proud to have launched the Eaglebrook Bitcoin Separately Managed Account, or SMA, which allows firms like Towerpoint Wealth to allocate to Bitcoin and Ethereum as well in a simple and secure way. The advantages of Eaglebrook's product include tax optimization, direct ownership of crypto, and portfolio integration, all of which afford us at Towerpoint the ability to potentially include Bitcoin as part of our clients' asset allocation and investment diversification strategy and overall financial and wealth management plan. So I'll be quiet and pass the baton over. Chris, it's my pleasure to have you joining us this afternoon.
Thanks, Joe. Really appreciate the introduction. Couldn't have said it better myself. Everyone that's joined today, thank you for your time. As I walk through the investment case of this asset class, the merits, the risks, how it fits in your portfolio, and like Joe said, why you would want to own it. So really appreciate everyone all the time that everyone here has given us. Going to go to the next slide. So we're going to initially go through the investment case specifically for Bitcoin. I think Bitcoin is the core building block in understanding this asset class. Once you can understand Bitcoin, it's a lot easier to understand how Ethereum can fit into the mix and the different markets that Ethereum and Bitcoin are both disrupting together. So we're going to go into the various aspects of that, exploring the qualitative argument for why you would want to own Bitcoin and allocate it into your portfolio. So taking a step back, I want to go into the history of Bitcoin and the core ideas that it was initially founded upon. So Bitcoin was founded in 2009 by a pseudo-anonymous founder named Satoshi Nakamoto. What's really interesting is that it was founded on 3 core ideals, one being decentralization, digital scarcity, and hard money. The most important one, I believe, is decentralization. What's really interesting about Bitcoin is that it's the largest decentralized asset in the world. There's no government, organization, individual, or country that can actually control Bitcoin in terms of governance, supply, or actually how it's going to fit into clients' portfolios, as well as the global economy. It's completely borderless and leaderless, which makes it incredibly valuable as a monetary asset that is truly global and native to the internet. The second piece is digital scarcity. What's really interesting is that some people make the comparison that, oh, Bitcoin is, AOL, Bitcoin is MySpace. What's funny enough is that people have been trying to build Bitcoin and figure out how to build digital scarcity since before the internet was even launched. Even in the late 80s, people were trying to figure out how to launch an asset that has digital scarcity, DigiCash, eGold, eMoney. There's a long list of these protocols that have actually failed, that Bitcoin was actually successful in creating this digital scarcity, where these assets online cannot be double spent. And just to make it, very simple, if I have a photo on my computer, I can send, one to Ryan and then one to Joe. However, if I have a Bitcoin on my computer, because there's triple entry accounting and digital scarcity, I can only send one to Joe, and the whole network where all the participants of the 120 million users of Bitcoin do understand that can't be spent twice, which creates this digital scarcity. As Bitcoin, there will only ever be 21 million in circulation, and there's currently 18.7 million in circulation right now. So 900 are mined per day. We're going to get into the transparent monetary policy of Bitcoin, but that's a very interesting feature and design of Bitcoin, which is why we've seen it grown from less than 1 million users in 2012 to over 120 million users today. The third is
just a quick question or point that is about the polar opposite of what we've seen here in the United States. Obviously, you're going to talk about this in just a sec with their capability to continue to print hard dollars. Please correct us if I'm wrong. This is exactly the opposite, where the cap on Bitcoins is 21 million, and that's that, correct?
Yes, that's exactly correct. And the last Bitcoin will be mined in 2140. So at that point, not many of us will be around at that point. But what's interesting is that the supply actually decreases incrementally by 50% every 4 years. And that's going to continue in 2024, 2028, 2032, all the way up until 2140, when the last Bitcoin will be mined. So right now, Bitcoin is, in terms of scarcity measured by stock to flow, it's close to gold. But by 2024, it will actually be more scarce to gold as measured by the supply rate. So its scarcity is increasing over time, right? It is quantitatively tightening, which is on a divergent path, as Joe pointed out, where all central banks in the world are quantitative easing. So fiat currency is on this one level, Bitcoin is on this other level, and that's why we've seen Bitcoin go from 500 to 1,000, 20,000, and then we've seen this recent run up in 2021. It's because of that core idea of hard money versus soft money, which is the next ideal Bitcoin was founded on, that has to do with digital scarcity. Soft money is money that's very easy for the supply to be increased very quickly, right? So US dollars, the ECB, the Euro, Bank of Japan, PBOC in China, they're all engaging in these quantitative easing plans and programs. and it's very easy to print the supply, right? Which makes it soft money. Bitcoin, on the other hand, it's cost $20 billion a year, and it takes power, energy, specialized computers to actually create more Bitcoin in a process known as mining, which makes it hard money as opposed to soft money where Jerome Powell can just point, click, and print $1 trillion fairly quickly. So I think that's.
So when you say quantitative easing, what you mean literally is money printing, both here in the United States and globally.
That's exactly correct.
And the other point too, from the standpoint of, I know we'll talk a little bit more about gold, so I don't mean to jump the shark, but there's more gold in the earth that we continue to have the opportunity to mine. Again, unlike Bitcoin, where after that 21 million mark, that's it.
That's exactly correct. And we're going to get into Bitcoin versus gold. But I think what's really interesting is that as demand for gold increases, there's more money to be made, which means you can increase the supply rate from an annual basis because, higher gold price, more demand, there's going to be more gold mined per year. Bitcoin, if demand goes up, the supply is transparent and fixed and never changes. Right now, 900 Bitcoin are mined per day. In 2024, 450 Bitcoin to be mined per day, and then decreasing 50% every 4 years. So as demand increases or stays the same and Bitcoin becomes more scarce, that's why we say this playing out over 5 to 10 time horizon, where it will reach close to parity with gold at a 10 to $11 trillion market capitalization. So those are kind of the backgrounds on Bitcoin and why it makes sense from a monetary asset perspective. So the way to view it from an investment standpoint is as an emerging store of value. It is not a store of value yet. It is still going through price discovery. But as more people become educated, as the market becomes more institutionalized, ETF is launched, right? Better custodians, more regulatory clarity, more infrastructure like Samsung, PayPal, right? State Street, Goldman Sachs, all these firms are building the infrastructure for the seamless transfer, financial markets, every capital markets related to it. All of that will be built out. But because it's such a new asset and people are still trying to wrap their heads around it, that's why it's not a store of value yet, because the market is agreeing upon what the value is and where it's going to go, over the next 5 years. But in terms of the characteristics of store value, Bitcoin scores fairly highly on all of them. The number one is trustworthiness. All stores of value and money is based off of the trustworthiness of the asset. Gold, art, real estate, US dollars, euros, that's what's really important. Bitcoin has gone from, like I said, 1 million users to over 120 million users in over 200 countries, right? Bitcoin is completely borderless. Less than 50% of the Bitcoin is held outside of the US, and over $800 billion of wealth is held in this asset, which makes it very reflexive and have these network effects that as this trustworthiness increases, as it's increased over time and follows a similar adoption rate, the price of Bitcoin will continue to go up on a longer term time horizon. Also, liquidity is a really important thing when you think about a store of value. That's why sometimes real estate and art aren't the best stores of value, because they have lower liquidity. Obviously, gold and US dollars have a little bit higher liquidity. Bitcoin is extremely liquid right now, right? It trades 24/7, 365 in over 200 countries in the world, right? And it's as liquid as Amazon, Facebook, Google, any of the large tech stocks. The third is purchasing power. We did some back testing and we saw that if you zoom out, obviously Bitcoin has retained its purchasing power over the last 10 years and actually has gone up a lot. But if you had held for 2.5 years or more, even if you bought at every single top over the last 10 years, you would still retain your purchasing power and had good returns from that investment. So Bitcoin has retained its purchasing power, even though in the short term, like what we've seen in the past 30 to 60 days, Bitcoin is a very volatile asset in the short term because it is a non-productive asset with no cash flows. So the market is still trying to figure out how exactly to value it in the near term. The last one is portability. While this isn't directly relevant for investors in the US, because we don't think that our assets are going to be seized or there's going to be any issues with that. However, in a lot of other jurisdictions with authoritarian governments, that's a big concern. So being able to leave your country with $10 million of Bitcoin in a private key in your head, going to another jurisdiction and recovering that Bitcoin makes Bitcoin extremely attractive from a store of value perspective when you're trying to get money out of countries with capital controls. So that's something that people are using right now, is basically offshore banking versus using, gold or US dollars, physical cash to hold your assets when you're in, one of those authoritarian governments. So I think that's another very interesting point on why it scores so high as the characteristics for store value.
And after after we're done with the formal presentation, if you could maybe touch upon what's happened in El Salvador, with them potentially adopting that as an official currency. I think that'd be useful for those who want to hang around a little bit.
Yeah, definitely. We can touch on that a little bit later. And then, so the similarities to gold, what we were kind of hitting on, our core thesis is that Bitcoin is going to disrupt gold and reach parity with gold for a few reasons. One, it's actually very similar to gold, right? It's non-sovereign, no one controls it. It's a scarce asset, only 21 million will ever be minted, and it has a low correlation to other financial assets like equities and fixed income, which can actually increase diversification. You add a 2 to 4% position to Bitcoin. So it has these similarities to gold as an investment. However, we're seeing all the major macro investors, institutional investors, large financial institutions start allocating to Bitcoin over gold for a few separate reasons. One, it is digital, right? It is native to the internet. And as we continue to move into the digital economy, Bitcoin will gain a lot of traction and momentum and adoption from that secular trend of just increased internet adoption and globalization. It's very cheap to store. It's very easy to send on the internet. I can send Joe $15,000 worth of Bitcoin. It'll be finalized with no financial institution, no wires, no Fed wire, no ACH within 10 minutes. And he'll have that. Where if I wanted to send you $15,000 worth of gold, that would take a few weeks and probably 20, 30 grand to send you that much worth of gold, just getting it shipped and getting it everywhere. So that's another piece, is that it's very easy to store and send on the internet. It's digitally native. And because of that, the millennial generation has adopted Bitcoin as a top 5 portfolio holding. And as wealth is transferred to the millennial generation, that is going to be a strong driver of demand over a 5 to 10 year time horizon. I also touched a little bit on network effects. Bitcoin is a network, right, where every single new user adds to the network adds value to every other user on the network, which Facebook, Uber, Instagram, Amazon, they follow a very similar viral loop or network effects that drives this this adoption of this asset class and of this technology. The third is that Bitcoin has a lot higher upside than gold, which makes it an asymmetric investment. If you allocated 4% to gold right now, I think there's a low probability of gold going to 55 trillion. However, I think Bitcoin taking 50% market share from gold, which would be around 7 to 10 times at these current prices, I think that would be very, very interesting from an asymmetric investment standpoint, where you're looking more at venture capital style returns. Obviously, the risk is a lot higher than investing in gold, but if you actually understand the investment thesis and understand the characteristics of Bitcoin and think that it can take 50% to 100% of market share from gold, this is going to be somewhere where you want to be allocated to over the next 5 years. Kind of go briefly into everything going on in the macro environment, right? US monetary aggregates are increasing. US money supply has increased 25% in the last 12 months, which is just, proves that that US dollars and other fiat currencies are soft money, right? Whereas Bitcoin is hard money that is quantitatively tightening. So this kind of goes to the same point. Quantitative easing that the Federal Reserve is engaging in is really driving the inflation that we're seeing, and also driving demand for assets that are alternative stores of value to keeping at your cash position in your portfolios. This really has to do, I think, is a really good chart that goes over Bitcoin's certainty around the supply and the uncertainty around the supply of fiat currencies in the US dollar specifically. If you zoom in and look at 2020 specifically, right, almost 25% increase in the monetary supply, where Bitcoin was 2.5%, and it just continues to decrease over time. So we're going to keep seeing that play out as this keeps being inflated, and this stays the same on a very strict monetary policy that is fully transparent to everyone in the network, that is decreasing over time, increasing the scarcity of Bitcoin as an asset. We're seeing a lot of institutional capital flow through. And a lot of these players are allocating because yields are at all-time lows, stock markets at all-time highs, and there is uncertainty around this monetary stimulus. We're seeing top investors in the world take large public allocations. Paul Tudor Jones, Elon Musk, Peter Thiel, Jack Dorsey, Stan Druckenmiller, major financial institutions and technology companies are building Bitcoin native products and solutions, integrating it to their applications and providing products to their large institutional clients. That's State Street, MassMutual, Fidelity, ICE, which owns the New York Stock Exchange, PayPal, Samsung, the list goes on. And it seems like every single week we see more news come out. 3 weeks ago, we saw, to Joe's point, El Salvador was the first country in the world to declare Bitcoin as legal tender and allow, the markets and merchants to be able to accept Bitcoin in a very seamless way with no transaction, trading fees, capital gains, none of that. And we're seeing a very strong demand of commerce to that country. And it's one of the first dominoes, in my opinion, that is going to fall, where a lot more South American countries, African countries, any country that has a weak fiat currency will essentially be sucked into this global monetary asset that they can adopt now, and that can help increase their chances of having a stronger government, stronger currency, as opposed to those weaker fiat currencies that are extremely volatile to the US dollar. So we think this is going to continue to increase. Public companies are going to continue to add to balance sheet. Financial institutions are going to come in, macro investors. What we do is work specifically with large wealth management firms. We're seeing a lot of them start to allocate in model portfolios and discretionary portfolios, which is just billions and billions of dollars of capital that is going to enter this market for the first time over the coming months and coming years. A lot of people focus on volatility and price and news and El Salvador and all of these things. And I think that's important to understand what's going on. But this, by far, from an investment standpoint, if you are a longer term investor, this is what you really need to look at and decide if you agree with or not. So Bitcoin and the internet are both technologies, right? Bitcoin is more of a financial technology and monetary asset. Obviously, the internet is more for communications, but they enable the same thing, right? The internet allowed for the transfer of information, right? Bitcoin allows for the transfer of wealth over the internet, which makes them fairly similar from an adoption standpoint. If you look at it, right, there's over 120 million Bitcoin users now. It has followed a fairly similar adoption rate to the internet. So right now we would be at around 1997, 1998 in terms of the level of adoption of Bitcoin. We think this adoption rate is going to stay the same over the next few years. And if it stays the same and follows a similar path to the internet, we'll have around 1 billion users and investors in Bitcoin by 2025, driven by all the things we're talking about, right? Increased access, institutionalization of the market, obviously volatility decreasing, better products for investors and users, as well as the uncertainty around fiat currencies, US dollars, what's the value going to be there and how this fits in. So I think that's a really key point, is that if you forget everything I said, understanding that it is following a similar adoption curve to the internet, and that's why it's going to continue to be important, over the next few years. That's why, why you'd want to allocate.
That's a great slide, Chris. And I think obviously it goes without saying that, adoption is the central theme within the ultimate long-term success of crypto and Bitcoin in particular. It's an interesting comparison with the internet. I guess the question I have for you is, so far to a large degree, and there's some differing schools of thought here, but for the most part, the internet hasn't been very regulated, at least here in the States, as well as globally. What concerns or what type of perspective do you have on the possibility of the United States government, other sovereign countries stepping in and doing more things to control and regulate crypto, Bitcoin in particular? And will that potentially have an effect on the light blue dotted line specific to this chart?
Yeah, so I think that's a great question. It's a very misunderstood question, where a lot of the investors and clients I talk to think that regulation is a bad thing and can hurt Bitcoin in the short term. I would say the only way that'd be true is if Bitcoin was outright banned in the US, which I think there's a very low probability of that happening, because that'd be like banning gold or other types of alternative stores of value, which I believe is unlikely. We embrace regulation, because what it does is it eliminates these questions and the uncertainty around how is the regulation going to affect it. So we really encourage the regulators to do more work, put out the rulings on custody, best execution, exactly how this can be managed, because that makes our lives easier and will actually make the institutionalization of this market and the regulatory framework a lot more clear, which will eventually bring more investors into this market that have concerns around the regulations. So that's kind of my thoughts. So we think, positive regulations are going to come out, which I believe this market should be regulated, but in a different way from the stock market, because it's not, similar. It doesn't trade on cash flows. It's not companies. It really is a decentralized asset class that trades completely on the internet 24/7, 365. So we really are excited to, for that to come out. And we work closely with our regulatory council, monitoring the regulatory environment and the new rulings coming out. So I think it's a net positive for the industry, as there's increased clarity around that.
Great.
So this is the last that I have before I think Joe's going to ask a few questions. The market cycle analysis. So we've obviously in recent volatility going from 64,000 to 29,000. Now we're about 34,000 right now. You can zoom out and look at the previous market cycles. How we view these market cycles happening is the first one to the second one, which was 2013, 2014, to the third one, which was 2017, to now 2021. What we're seeing is a trend where these cycles are increasing over time and the returns are decreasing over time, right? So we think this cycle is actually not fully played out yet. There's still probably another 6 months from this line. So we still have some time in this bull market, even though we've seen a major drawdown that has been lasting for the past 60 days. We are going to see increased volatility. I think July is going to be a really interesting month to look at the price action. But we think that this cycle is going to be longer than the 2017 cycle, and that returns will be lower than the 500 or 5,706 times your money to the 55 to over 1,000 times your money in cycle 3. We think this will be a lot lower in terms of return. But now that this market is a lot more accessible and people understand it at a deeper level, adoption has increased. It has been significantly de-risked, and now it's just taking a little bit more capital for us to realize where this market is going, and the cycle lengthening over time as we're in the 4th cycle right now. So Joe, do you have any specific questions on anything on the qualitative side? Because then I can kind of go into portfolio implementation, all those things.
Yeah, in the interest of time, I think let's continue the pace. We've got a couple good questions from some of our audience members that we'd like to get to. So keep it going, Chris. Thank you for your help so far.
Yeah, of course. So this is the last 4 slides. We're going to talk about how Bitcoin fits into a portfolio. I think the biggest concern is around volatility and regulations. I addressed the regulatory landscape in terms of volatility. Bitcoin is going to be volatile in the short term and has over time, but so have all of these other assets, right? Tesla, gold, silver, Apple, NVIDIA, obviously emerging markets, the British pound, euro, all of these things are volatile. And if you're going to make an investment with an asymmetric return profile, you're going to have to be able to stomach volatility. But how we work with clients is that, hey, if you're going to allocate to this asset class, you have to look at it from a 3 to 5 year time horizon. You can't get cold feet if you're seeing a large drop in the market. Because if you zoom out, 2.5 years, Bitcoin has retained its purchasing power over time.
Chris, can you regale our audience with HODL?
So, there's ethos in Bitcoin is that, obviously you should never sell. People say, HODL, which was just someone accidentally misspelled back in the early days, hold Bitcoin, but it's really just around the concept that there is volatility. It is scary to a lot of first-time investors, but it's nothing new if you zoom out and look at other assets that do have a similar volatility. So it's important to hold over a longer period of time as opposed to trying to trade in or out yourself. You want to kind of decide on what allocation, let's say 4%, allocate either with market entry strategy, dollar cost averaging. Then once you're allocated, you'll have that position over the next 3 to 5 years that you can obviously watch, educate yourself, and understand this market.
So 2 quick points there. I mentioned the acronym of HODL, which is the word I use as HODL, is hold on for dear life. Obviously, Chris, to your point, day to day, week to week, month to month, quarter to quarter. If you're a trader of crypto and a trader of Bitcoin, then that type of price movement certainly is important. Obviously, as we continue as an investment committee here at Towerpoint Wealth to work with clients to potentially integrate crypto into a properly diversified portfolio, to your point, we certainly want to be aware of what's happening day to day, week to week, month to month, quarter to quarter, but not getting too excited, not getting too worried, understanding that this type of volatility should be expected open-ended. But at the same time, if you have belief in the story and in the legitimacy of everything that you've outlined so far, then having the mindset of a 3, 4, 5-year window at a minimum, just like any other investment or asset class that comprises a properly diversified portfolio, obviously is important to maintain. Another quick question from one of our guests today: what should we, and this is probably more of an answer that Towerpoint would answer offline, but what are you seeing clients or clients of the advisory firms who you're serving move or transfer to allocate 2, 3, 4, 5% of a portfolio to crypto or to Bitcoin?
Yeah, so I think this is a really interesting data point because we've seen it in a few different ways. Some take it out of the alternative investments bucket. Some take it out of the cash position, right? Money market accounts, things like that. But what we're actually starting to see more often than not, probably about, I would say over 50%, is taking that 2 to 4% allocation out of public equities, and specifically that technology bucket, which has similar, volatility. Obviously, Bitcoin's a little bit more volatile at this moment, but because Bitcoin really is a technology investment and it's disrupting a incumbent market, which is the gold market, and has similar risk return profiles to technology investments. So given that structure, that's where we're seeing it being taken out, as it is a risk on asset that is, investing in technology that's disrupting this market. But the interesting part of it is that it does not, and this slide's a good testament to it, it has a low correlation to technology equities, which makes it a really strong and compelling argument to actually loop it also in the alternative investments bucket, which can reduce exposure to economic cycles. So when all major assets are going down in our next bear market, for the stock market, Bitcoin can actually be on a divergent path because it is not tied to any financial market. It's not tied to any jurisdiction. It's not tied to any economy or government. So I think that's what's really, really important. But short answer is that taking that 2 to 4% out of equities, specifically technology equities, and allocating that to this asset class.
Yeah, and I mean, we've had this conversation with a number of clients as well, and we can move forward after this. But if you're allocating, let's say 3%, to do a very, very minor haircut of 1% in 3 of the other slices, if you will, of your diversification pie, you don't want to minimize it, but frankly, it's not that big of a deal in order to pick up whatever complementary allocation we feel may be appropriate for you to crypto. So it's not too big of a a major shift in the portfolio. And I think, again, to your point, at Towerpoint, one of the major things that we find attractive is the fact that these, the word is correlation. And if we're able to blend and to fold in different, again, slices of your diversification pie, some zig when others zag, and some aren't related to each other, overall, when you're looking at not just the trees, but the entire forest, it really helps us as a tool to, not eliminate by any stretch of the imagination, but really able to reduce risk and to minimize the volatility of the portfolio as a whole. So very, very important.
Yeah. And I just saw a question that I wanted to address, because I think this is one of the most common misunderstandings or misconceptions, is that Bitcoin, people call it a cryptocurrency. I really lean towards calling it either a digital asset or a monetary asset. It is not a currency, and people like to view its adoption based on, the US, people in the US using it, or, it being used, to buy your coffee, your car, your computer. That is not the case. You want to view Bitcoin more as a savings account that is there to store value, as opposed to something that you're going to buy with. So Bitcoin is not a currency. I don't believe it will be a currency for 10 years until it actually reaches parity with gold. Then, at that point, people might, have this, mainstream adoption, hyper Bitcoinization could occur. And at that point, people might start spending it. But right now, it doesn't really make much sense to spend it when it is disinflationary. The supply, the scarcity is increasing, and we believe demand is going to increase. So it doesn't really make sense to spend your Bitcoin. So we're actually, another interesting point is that 78% of the supply of Bitcoin is actually offline, meaning it's in these long-term accounts that all of these people are actually using it to store their wealth as a global savings account. So a lot of Bitcoin analysts and core developers of Bitcoin like to call Bitcoin savings technology, because if you put 500 grand in a savings account in US dollars, getting less than 2-3%, that's not really that attractive. However, and obviously the central banks inflating the monetary policy, that's not very attractive place to keep that $500,000. But if you wanted to combat that and put that into Bitcoin, that can be a lot stronger of a compelling argument. Hey, I'm voting with my money. I believe this is a store of value. 120 million other investors believe it's a store of value. So it's more of a savings account, an alternative store of value versus ever being a currency,
Right.
which I think is a really important point.
Well, and why use it as a currency when it's as volatile as it is, number one. And obviously, I think you're probably in agreement that as the adoption increases, a volatility should, over time, I would think go down. And at that point, when people become more comfortable using it as currency, then, the story might change a little bit, but I appreciate you highlighting that.
Yep, exactly correct. Next slide. So this is just a graph of these numbers. I think the important thing to point out here is the reduction of risk and the increasing of the Sharpe ratio, where it really does not increase risk by that much. If you look at a standard 80-20 portfolio, right, 14.3% standard deviation, 27.1% drawdown, you're very small, not an immaterial change to the risk profile of your portfolio, but you're actually adding a 4% position, which has greatly increased the cumulative return, right? The average return rate, 19% versus 30, while only putting 40 basis points of max drawdown, and then 70 basis points of standard deviation. So I think that's very interesting in terms of the risk of the portfolio. And then obviously your Sharpe ratio going from 87 to 1.34 makes the risk return profile of adding a 4% position very attractive from a portfolio construction standpoint.
And that's stuff that if I have clients or we have clients that want to talk about those details, look forward to it, but appreciate the spirit of that slide.
Yeah, of course. So that's it. Happy to answer or address any other questions.
Well, good. Let me, if I may, just take a moment to, end the formal portion of the presentation, and obviously thank our guests who took time out of their day today to participate in our webinar. Chris, again, thank you very much. Obviously, not only for your expertise, but your time as well. Certainly, we can talk a little bit more about Eaglebrook's product, how that may or may not fit. I know we've made a lot of important points, and frankly, there's a number of follow-up questions that speak directly to, how exactly, if I do want to be on board with this, how do I get and gain exposure to Bitcoin? So for those of you who have things to tend to, we certainly understand and feel free to follow off. And at the same time, let's continue the conversation then with some of the follow-up items that we've discussed. So first things first, Chris, what about how is Bitcoin stored, or how many different ways are there to store Bitcoin? What's the best, and how is Eaglebrook helping clients of Towerpoint, if in fact that would be appropriate?
Yeah, so I think this is the most important point, and what I've spent the last 2 years on is the security and safety of these accounts. There's two ways to store Bitcoin: a hot wallet, which basically just means it's connected to the internet, and cold storage, which means it's offline from the internet. If it's in a hot wallet, it's very easy to be hacked, which is why you keep hearing people's Coinbase is getting hacked or Bitcoin being stolen. it's in a hot wallet connected to the internet, and that's what Coinbase uses if you would go buy, 500K on Coinbase. However,
let's stop right there. So Coinbase is a crypto currency exchange, correct?
Yeah, that's correct. Yeah.
Okay, just for people who may not be familiar with that. And so to your point, when you use the phrase hot wallet, what that means is you don't physically possess a device that holds your coins or your crypto, but it's all held in an account on the internet.
Correct, yes. And then cold storage actually utilizes hardware security modules, which it just looks like a USB drive, right? But that holds the Bitcoin. And on our system, each client owns their own Bitcoin in their hardware security module. We work with a qualified custodian, similar regulatory structure to Fidelity and Schwab, actually the exact same. And they have to follow all the same rules as the custody of your assets on Fidelity or Schwab, but they do it with Bitcoin instead, all offline from the internet in tier 4 data centers, right? In these hardware security modules with the highest level of encryption possible, which is, infinitely more secure than having it on hot wallet. So that's a really big, piece of
counterintuitive with everything that is digital today, that you're actually saying, hey, owning it by holding the basically enhanced thumb drive in a security center is more secure than holding it on the internet.
Yes, that's correct. Because then,
which is opposite of the overall Bitcoin and crypto story, but specific to storage, that's an extremely important point.
Exactly correct. And people are building out technology for you to be able to trade and rebalance and transfer, all while keeping it in cold storage. So you can still use it, right, in whichever ways you'd like to, but it's always going to be held in that cold storage versus that hot wallet. So that's really interesting technology that we've built and other, investment firms and infrastructure players are building out. That's
great. So follow-up question, similar in terms of gaining exposure to Bitcoin or to crypto in one's portfolio. Is this doable at a major Wall Street firm? And is this doable in retirement accounts like traditional and Roth IRAs?
Yes, so for the most part, it's not available at traditional Wall Street firms. I think the only major one is Morgan Stanley that put out a crypto offering for their clients that have $5 million and up in liquid net worth. So that was, one piece of it. So right now it's really not available there. It's not available at Fidelity or Schwab or TD or any of those brokerage houses. However, we have spent the last 12 months building out an IRA solution. So you can actually own Bitcoin in a self-directed IRA working with us. So you can own it in that tax advantaged account. So that's something that we've built out that's fully proprietary. So you can actually own Bitcoin and Ethereum in your accounts.
Very good. Simple question, simple answer. From a tax standpoint, if I buy Bitcoin and sell it 2 weeks later, what's the general tax environment to losses and gains?
Yeah, so short-term capital gains, long-term capital gains, same as equities or fixed income. So it follows the same rules from that perspective.
Could you touch upon briefly the benefits of being able to sell Bitcoin at a loss and then buy it back without being subject to the wash sale?
Yeah, so with traditional securities, there's this thing called a wash sale rule, where if you own Apple and it went down 20%, you can sell it, but you have to wait 30 days to buy it back. And obviously it's not going to be where it was when you sold it originally. So there can be a higher variance on the up or down side. With Bitcoin, it's different because Bitcoin is technically property and not a security. So what's interesting is that there's no wash sale rule. So if you're down 20%, you can sell that Bitcoin, buy it back within seconds. So you'll buy a different tax lot of Bitcoin, but then you'll have that, let's call it $100,000 capital loss to defer taxes at the end of the year while owning the same amount of Bitcoin and Ethereum, which is very advantage from a tax optimization standpoint.
Yeah, tax arbitrage is important, and I know here at Towerpoint, one of the things we found attractive, and this is not meant as a commercial for your product, but at the same time, the tax benefit to being, if it goes down, right? All right, we're going to expect that that's going to happen. Not have to be happy about it, but it's the nature of the product right now. To be able to take a loss, which you can then use to offset other capital gains, but still buy the Bitcoin back right away rather than having to wait 31 days, which is typical for more traditional investments, is hugely attractive from the standpoint of tax planning. So I wanted to make sure we highlighted that. Chris, what about from an ESG and a responsible investing standpoint and renewable energy? It all ties together. I've read and have a couple questions here that allude to the same thing. Elon Musk has made a big deal of this recently as well in terms of Tesla accepting or not accepting Bitcoin. Can you comment on A, how much energy it takes to mine Bitcoin, and B, what type of ideas or things are being done to reduce the carbon footprint associated with mining Bitcoin?
Yeah, that's a great question. So this is obviously top of mind. Elon Musk put out, uncertainty and fear around, what the ESG is. I think what this has also sparked and what has led to this drawdown from basically 60K to, now trading in the 30s is that China, which had most of the non-renewable energy, right? Basically the non-ESG friendly Bitcoin miners, they're actually moving that out of the country, which reduced the hash rate of Bitcoin. But now that's moving to more ESG friendly sources, which is actually cheaper to use. For example, you can put a major solar farm in the middle of Texas, right? Not close to any power grid. And it's economical to mine Bitcoin because you can mine Bitcoin right on the premises. So we're moving more towards this renewable energy, nuclear, solar, wind, right, hydroelectric. I believe, obviously the data isn't very clear, but from what I've read and what we've been working with a ton of the Bitcoin miners and the analysts is that Bitcoin is over 50% renewable, and that was up from 30%, and that's going to steadily increase to the goal, which is 100% renewable energy for the full Bitcoin network. So we're getting there, and I think the exodus from China is helping out, but it's still going to take some time. The miners just formed a council where everyone's sharing the data related to their mining. Is it coal powered? Is it hydroelectric? All those things associated with that. So Bitcoin, we believe, will actually increase the technology investment into ESG friendly energy sources, driving the price down, and then increasing, the green, energy revolution that's just going to continue over the next 10 to 20 years.
Yeah, and then, obviously as adoption increases and potentially the price increases, it certainly is an incentive for miners to, find friendly areas to do that mining. And, I know Texas has been at the forefront of that here over the past couple of months and recognizing those opportunities. And I'm sure they won't be the last state here in the United States that recognizes that, hey, this renewable concept is important to people. And if we're going to mine it, we've got to mine it in a proper and ESG or environmentally friendly way. So I appreciate that. I don't know if it's too complicated of a question, but how do I mine a Bitcoin, or what does mining even mean?
Yeah, so this is fairly complex. The answer is unless you have a few $1 million and access to large kilowatts of energy, megawatts of energy, and the knowledge to mine Bitcoin and be able to source it, it's fairly difficult. Sure. I could have mined it in 2010 on my laptop, but the difficulty increases. Basically, what mining is having these data centers with these specialized hardware computers called ASICs that are basically just computers that are specifically built to mine Bitcoin. And what that does is it tries to solve a cryptographic algorithm for basically the Bitcoin network to mine Bitcoin every 10 minutes. And basically, just when you think about Bitcoin mining, it's these massive data centers that cost hundreds of millions of dollars all across the world, basically in every single country, mining Bitcoin by running these computers. And every time that the Bitcoin puzzle is solved every 10 minutes, those miners get a fraction of the Bitcoin mined in that block. In that period.
Where is the transfer taking place? If I mine it and my computer gets the algorithm correct and I get some amount of Bitcoin, where is it being transferred to me from?
So Bitcoin is a global network. So it goes on the Bitcoin network, essentially.
And that's blockchain in a nutshell.
Yeah, exactly. It goes on the blockchain to your public key or your Bitcoin address that you were using to mine that Bitcoin.
Got it. I mean, kind of. Dark money, fraudulent transactions, criminal activity. Obviously, crypto, Bitcoin, pretty attractive to potentially use as a currency to fund those things. Is that a problem, in your opinion? And should we be concerned about that as an intermediate / long-term owner of crypto?
Yeah, so not at all. This gets a bad rep because back in 2011 and 2013, the first use case of Bitcoin was the Silk Road, which is what a darknet website, a basically marketplace where sold drugs, things like that. However, since then, the DEA, FBI, NSA have gotten really good at tracking Bitcoin transactions. So now only really bad criminals use Bitcoin as a currency. About 99% of the nefarious activity that occurs in the world, terrorist financing, drug cartels, things like that, that happens with US dollars. And very little of it happens with Bitcoin. So, that's really not a concern from an ethics standpoint, because, the forensic accounting related to the Bitcoin blockchain is so robust now that if you're doing something and using Bitcoin, you're going to get caught almost immediately by using IP tracking and forensic accounting.
Well, and the whole blockchain is public, is it not?
Exactly, fully public to anyone in the world with basically internet access.
Right, right. So just pivoting quickly, I've got 2 or 3 more questions here and then we'll wrap things up. But, understanding that I think the takeaway was, hey, we really shouldn't be thinking about Bitcoin as a currency. Yes, it is, but it's so crazy and volatile and probably not the best way to be thinking about it right now. Assuming the rules stay the same in having to report the buy and sell transactions as capital gains or losses, is that not going to be an impediment to using Bitcoin for regular transactions, let's say five years from now?
Yeah, so I don't think Bitcoin's going to be used for transactions for 10 plus years. And at that point, I think the regulatory landscape will change because Bitcoin is adopted from a global perspective. Maybe in the US, it'll still be taxed as capital gains. But in El Salvador, which just allowed it to be legal tender, there's no capital gains associated with it. It's legal tender, right? There's no gain or loss associated with buying your groceries with Bitcoin in El Salvador. So that's why I think it's a piece is that Bitcoin will eventually become legal tender in more South American countries, more Southeastern Asian countries, African countries, things like that have weaker fiat currencies. And as that continues, that will reduce that risk of the taxable event for using it as a medium of exchange.
What's Ethereum?
Yeah, so Ethereum is very different from Bitcoin from an investment standpoint. You can think of Bitcoin as basically digital gold. Ethereum is more of a protocol that all these entrepreneurs and these other applications are building on top of, similar to how Facebook, Amazon, and Google built their applications on top of HTML, which is basically just what the protocol that runs your web browser and your web app. So I think that's a really interesting piece is that all the smartest engineers, entrepreneurs, developers, even marketers and people that work in finance are moving to build on top of Ethereum. And while we're still in the very early stages, what they're building is a new financial system that has higher yield, is more transparent, and is more efficient. And as that continues to proliferate, owning the actual asset Ether, which is how the Ethereum network operates, that's going to increase in value over time. So still at the earlier stages in terms of global and commercial use cases, but those applications are starting to gain fairly high traction. Less than $1 billion was locked in Ethereum and in decentralized finance in early 2020. Now in 2021, over 100 billion is locked in it. So a lot more people are using these products and services because they have higher yields, right? Everyone's looking for yield. They are more transparent. You can audit each financial product that you're investing in. And then 3, they're a lot more efficient to use as opposed to using the traditional banking system and wires and ACH and trading and all that stuff. So I think it's a really interesting piece of that.
Much more lubricated system, if you will. And then, are these other cryptocurrencies correlated with Bitcoin? Bitcoin goes up. Do these other ones tend to follow it and vice versa? Or because they're different in ways that we're still trying to understand, is their correlation not so high with Bitcoin?
Yeah, the short answer is that they are correlated in different bouts. Ethereum can take market share from Bitcoin, Bitcoin can take market share from Ethereum. That continues to play out through these cycles. But as we see, when Bitcoin's down a lot yesterday, everything else is going down. When Bitcoin goes back up, everything goes back up. So we kind of see that playing out. But you're exactly right, is that some of these lower cap coins can become uncorrelated with Bitcoin as their metrics change and more people are using them, and there's actual commercial adoption.
Good. Why did the hackers of the Colonial Pipeline pay in Bitcoin and just not in dollars?
That's a great question. And what's interesting is that they did that, but then they got tracked and found out who they were, and their Bitcoin was stolen back by the FBI because it was in a hot wallet. So everything kind of comes full circle.
Crazy.
Yeah.
I want to invest in Bitcoin, or we have a client who wants to invest in Bitcoin. Very broad-based, big picture question. How do we engender the confidence? How does Towerpoint Wealth engender the confidence? How does Eaglebrook engender the confidence that what the ultimate client is owning and investing in and purchasing, whatever word that you want to use, how are they able to be confident that it is real and not a con? I mean, you hear things on TV and on the internet that people are losing money to people posing as Bitcoin. And, I don't know if you're able to directly answer that or not, but, how are you helping people to be confident that that's not going to be the case for them?
Yeah, you can verify it on the Bitcoin blockchain. So anyone can go on Blockchain Explorer, just type in Bitcoin Blockchain Explorer. We give you a public address. You type in that public address, and the Blockchain Explorer is completely outside of Eaglebrook or Gemini or Towerpoint, and you can audit and verify that you do own those 7.4 Bitcoins on the Bitcoin blockchain. So it's fully auditable from a third-party perspective because it's a fully transparent network that anyone has access to. So that's how you verify that the Bitcoin that we say you own or Towerpoint says that you actually bought. So it's
check it and verify.
Triple entry accounting is what they call it.
Well, and plus again, the cold storage versus hot wallet, obviously, I think plays a part in that as well too, right?
Definitely. Yep, that's correct.
Good. You've been doing this for a while now. I'm curious, any other important questions or issues that I think our attendees would benefit from, or is this a good inflection point? Just curious what else may be on your mind to share with our guests.
Yeah, so I think we covered a lot of it. I think the most important thing is I gave you a high level for this past hour, but going back and doing your own research based on the talking points that I went into. Obviously, a lot of misconceptions, but really, we don't want to, we don't want you to allocate to this asset class based off, FOMO or emotions or someone told you to do it. We want you to actually have conviction. By understanding all the characteristics, everything we just went over, and have that longer term time horizon. So I would just recommend doing a little bit of your own research and your own work. And then once you feel confident that you really understand it, because you want to be investing in new asset class and new technology that you actually understand. So I think that's a big piece of it, is doing your own research, coming up with your own conclusions based off the information that me and Joe just provided.
Good. Yeah. And I we feel the same way at Towerpoint. Obviously, it's a new and exciting technology and asset class. New and exciting can be good. It certainly can be exactly the opposite of that. But as adoption continues, and as I think the educational learning curve, which you've obviously helped today with our guests and our clients, we feel it's not going away. If anything, obviously adoption rates, and I think your chart you shared us earlier as compared to internet adoption was a very useful one. We're still in the second inning of this thing. And I think that plays a large role in being open to understanding the ever-evolving investment environment, and not necessarily just being static to the type of investments you allocate to, but having an openness and frankly an understanding and a responsibility to continue to do due diligence on opportunities that may end up helping to complement a portfolio. And ultimately, what are we trying to do is help our clients protect their net worth and certainly grow it as well. And we look forward to continuing to adopt Bitcoin and crypto, albeit in small doses, for the clients who we feel is appropriate for. So with that being said, Chris, thank you. Thank you all for who's remaining as far as our guests. And it was a productive webinar, and I think it was great.
Awesome. Thank you, Joe. Thanks everyone for the time.
Cheers. Have a good afternoon.